First concept we're going to look at today is the trend. You can sort of see the trend as the base concept. Trends are everywhere, and one of the fundamental assumptions of technical analysis is that the trend is your friend until it ends. And the assumption is the following, that a trend can be equated to something similar to a habit. If it's going in one direction, it's likely going to continue in that direction until it changes. And if you think about habits, habits are recurring patterns, and of course they can change, but they're sticky. So that's the concept of the trend. Now in technical analysis, a valid trend has a minimum of 2 touch points connecting either the peaks when we are going in a downtrend or the troughs when we are going in an uptrend. Now there are 2 points that make a trend very powerful. The first one is the more points that touch the trend line, the more powerful it is and the more likely it is to last. The second is the longer the trend, the more powerful it is and the longer it is expected to last, as well as the more important it is when the trend is broken. There are 3 different types of trends. There are upward trends, downward trends, and sideways trends, or in other words, trading ranges. You can also break up trends into 4 different categories. There is the primary trend, which you can see as the mother of all trends, which can last between months to years. When the primary trend is broken, that's a very, very bad sign. And so that is always the first thing that you have to reference when you are looking into going long on a stock. The second category is secondary to intermediate trends, which is months to weeks. Then we have minor and short-term trends, which can last days. And then finally we have daily or intraday trends, which can last a few hours or a few minutes. That wraps up the first lecture on trends. Thank you so much for watching. I really appreciate your support. See you in the next video.